Today, the lowdown on banking finance statistics. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today I want to discuss the latest data that APRA has released. It relates to ADI statistics, specifically those relating to lending, and to the end of April 2019. And we get some quite interesting insights into what is actually going on. Now, these statistics are released at the end of each quarter, and the next edition, the June 2019 edition, won't be released until the 18th of September. So this is very much a rear view mirror exercise, but nevertheless, I think we can gain some insights by looking at it. So this data is released as a series of spreadsheets, and there is also a PDF report. But of course, I've gone directly to the spreadsheets, and I've created a series of charts that we're going to walk through. Plus, we'll explore some of the high-level data that they've actually also shared based on their own analysis. So let's start with commercial property exposures. Actually, this is quite an important area because, of course, commercial lending is potentially under the gun if and when the economy eases. So they say that commercial property exposures for all ADIs or banks were $287 billion as at the 31st of March 2019, and that commercial property exposures increased by $12.6 billion or 4.6% compared with a year earlier. And commercial property exposures within Australia were $247 billion, which makes around 86% of all commercial property exposures, and total commercial property exposures represents around 85.4% of all commercial property limits. Now, the largest categories of property exposures were office properties at $88.3 billion and retail property at $72.9 billion. And these represented 30.7% and 25.4% of all exposures respectively. So the key takeout here is that the bank's exposures are predominantly to the office sector and the retail sector. Now, as we've discussed earlier, the retail sector is possibly in recession. So this may well have an impact on property exposures later. That said, impaired commercial property exposures were just $519 million at the 31st of March 2019, and that's a decrease of $46 million or 8.2% from the previous year. And impaired commercial property exposures were just 0.2% of total commercial property exposure. So really, there is not much evidence of any strains or stresses in the commercial sector at the moment. So now let's turn to residential property exposures. And again, we'll start with the APRA data before we go into some more detailed analysis that I've done. So they say that residential term loans to households were a total of $1.67 trillion as at the 31st of March 2019. And that's an increase of $67.1 billion or 4.2% compared with the prior year. Of these, owner-occupied loans were $1.12 trillion or 67.2%, and that was an increase of $63 billion at 6% from the prior year. And investor loans were $546 billion or 32.8% of all loans, and that was an increase of just $4.1 billion, 0.8% from a year earlier. So once again, we see that all of the growth pretty much has been in owner-occupied lending in the last 12 months. The average loan size was approximately $277,000, compared with $269,000 as at 31st of March 2018. And $383 billion, or 23.3%, were interest-only loans. And we'll look at the growth of new interest-only loans shortly. Now, we can do a deep dive into this data and look at the categories by the different types of banks. So we have all the ADIs totaled together. We have ADIs excluding mutuals, which we'll call banks. We have the mutual sector, which includes building societies and credit unions. We have the 4 major banks. We have the other banks, so that's the regional banks. And we have foreign banks. And it's quite interesting to watch the dynamics across these various categories. And we're going to start with new loans approved outside serviceability standards. And we're going to look at the relative value of loans so approved. And we start with all ADIs. And you can see that in the last quarter, about $3 billion of loans were approved outside standard serviceability criteria. And if you look at the trend since 2010, there's a clear upward momentum suggesting that the banks are breaking their own rules more than they used to, although recently it's come back a little. Now within that, the banks have the lion's share because the mutual sector is very small. And the major banks within the banks have by far the largest footprint. So just under $3 billion in the quarter written by the majors are outside standard serviceability criteria. For other banks, it's much smaller and it's dropping away, and the foreign banks hardly register at all. But if we look at it in terms of the percentage of the portfolios of new loans being written, we get a slightly different picture. So here we can see that across the whole system, about 4.25% of all loans written now are outside standard serviceability criteria. And that's quite a bit higher than it was until very recently, although we saw a bit of a peak back last year. And if you go back to 2010-11, the percentage was quite a lot smaller. So effectively, banks are breaking their own rules more. And of course, because the mutual sector is such a small sector, most of it's sitting in the bank sector. The mutuals, you can see, has quite a wavy line. Remember, we're looking here at the relative proportion for them rather than the absolute proportion of the total market. But what is obvious is that since the middle of 2018, mutuals, building societies and credit unions are breaking their own rules a lot more. But the standouts are the major banks, and in March 2019, 5.1% of their loans were written outside standard serviceability criteria. Now that's a bit of a drop from a few months ago, but it's still significantly higher than the market. Whereas the regional banks are significantly lower, just around 2%. And the foreign banks, which were a little higher, have been dropping away. So we can conclude from this that it is the major banks who predominantly are writing the most loans outside standard serviceability criteria, aka higher risk loans. Now let's look at new investment loans, firstly by value. And we can see there that back in 2015, they were traveling at around $40 billion a quarter. Now it's nearly half that, close to $20 billion a quarter. And most of those are written by the banks. The mutuals, again, a very small proportion of the total market by value. The major banks have the most significant footprint, but we can see a very significant decline there in recent times. The regional banks have not had anything like the same decline, which is quite interesting. And foreign banks have continued to perform roughly as before, with relatively unchanged trajectory. But if we look at it in terms of the proportion of their own portfolios being approved, these are new loans, of course, new investment loans approved, you can see that around 30% of all loans for the ADIs are for investment purposes. And that's pretty similar for the banks. The mutuals have a lower percentage, so they're doing around 22 or 23% of their portfolios as investment loans. The major banks are at 31% of all loans written, so they're above the average, whereas the regional banks are a bit below, and in fact they're turning down a little. And foreign banks are sitting at about 17 to 18% of their loans that are written. So there are a higher proportion of investment loans being written by the major banks compared with the rest of the market. So now let's turn to new interest-only loans approved by value. And you can see there's been a massive turn away across the banks. There were peaks close to $45 billion in 2015, and now it's around $10 billion in a quarter. And the banks have the bulk of it, the mutuals hardly any at all. And the major banks make up the most significant proportion of the value, of course, but again, they've seen the drop recently. The other banks have also seen a drop, and foreign banks too. So you can see the effect of the APRA tightening of interest-only loans. Now, of course, since then, APRA has loosened the taps a little, so we may see interest-only loans ticking up in future quarters, we'll see. But we should also look at this data from a proportion of portfolio perspective. So on that basis, ADIs have around 15% of their portfolios for new loans in interest-only loans now, relative to more than 40%, in fact closer to 45% back in 2015. So you can actually see the two troughs created by APRA's initial speed limit and then the focus more specifically on interest-only loans approved. Most of those are in the banking sector rather than the mutual sector. The mutuals have a lower proportion of interest-only loans approved. The major banks are at 15.4% of their portfolio. Regional banks pretty close too, and foreign banks lower and falling away. So you can see how the major banks are continuing to lend for interest-only loans, but at a lower level than back in 2005. Now, it's also worth looking at new loans approved via brokers across the banking sector. So around 50% of all loans are originated via brokers, and you can see that trend up since 2011 has been climbing from 40 to 50%. This is in terms of the value of all loans. Within that, the bulk of them are in the banking sector rather than the mutual sector. And you can see that the mutuals are significantly lower. So currently they're sitting closer to the 30% mark. And it's interesting that in recent times they have fallen away. The major banks are sitting at around 47.9%, and there's been a slight reduction there. That's partly because recently banks have been focusing on using their proprietary channels, the branch networks, rather than using third-party channels. The regional banks have a higher proportion through the broker network relative to the majors, and foreign banks have close to 70% of their business being written via the broker, the third-party channels, which is perhaps not surprising because they have a less extensive branch network. And it's worth also just looking at it by value, because of course value translates to commissions for brokers. So what's happened to commissions for brokers? Well, new loans have dropped away, as you can see there. So essentially we were seeing around $50 billion a quarter back in 2017, and that's now dropped to around $35 or $36 billion a quarter. So still significant, but significantly lower, which means that broker commissions are down. And we can see that the bulk of those are actually in the banking sector rather than the mutual sector, although the value by our mutuals is a little lower than it was. Major banks, of course, have the lion's share, but in the last little while you can see that the value of loans being written via brokers has dropped from over $30 billion a quarter to around $23 billion. That's quite a significant drop. The regional banks have also experienced a bit of a drop, but not so significantly relative to the majors. And interestingly, foreign banks have seen some growth more recently, with just a slight tailoring away in the last 2 quarters. And then finally, we're just going to look at the loan-to-value ratios, and this is the percentage of new loans being written by the 4 loan-to-value ratio bands. The first one to look at is below 60% loan-to-value ratio, so the least risky loans. And you can see that across all ADIs, under 30% of loans are in that category, and there's been a slight rise since 2014. Most of those are in the banking sector, of course, whereas the mutuals seem to be a little bit more volatile. That's partly the lower volume, of course. But you can see there that of just over 20% now are below 60% LVR. The major banks reported 26.5% in March 2019. And so the regionals are a little higher, so they have a slightly bigger share of low-risk loans, whereas the foreign banks have a lower share of low-risk loans. If we then look at the 60 to 80% loan-to-value ratio, and remember that prices have dropped from their peak in some centres more than 20%, so some of those loans now could be underwater. And you can see there that this is where the bulk of the loans are being written. More than half of all loans from the banks are between 60 and 80% loan-to-value ratio, and most of those map through to the banks. The mutuals, pretty much the same, just maybe slightly higher. The majors sitting at 51.1% of all loans in that category. Other banks pretty close too, and the foreign banks just slightly higher. This is where things really get interesting. So we're now looking at the 80 to 90% loan to value ratio. So these are higher risk loans. And you can see that just under 15% of all loans being written at the moment are actually between 80 and 90% loan to value ratio. So these would be subject to significant risk even if prices dropped no more than 10%. And you can see that that has been lower than back in 2011 and 12, but it's been knocking around the 15% since then. And most of them are in the banks themselves. The mutuals are a little lower, so they have a slightly lower share of higher risk loans. The majors have a slightly higher share of high risk loans at 14.9%, compared with the regional banks who are sitting at about 12%. But foreign banks, and I was surprised by this, foreign banks are writing about 20% of their loans at the moment in the 80 to 90% category. So they are effectively taking more risks than the majors or indeed the regionals or mutuals. And finally, we look at loans approved above 90% LVR. So these are the really high risk ones. Less than 10% movement could well mean that these households are actually in negative equity. And here we can see that that has dropped away. It's about 7% now, a little bit of a peak compared with a few quarters ago. And most of those map through to the banking sector. But the mutuals have a higher proportion now of 90% and above loan-to-value ratios. They're sitting at close to 13% of loans being written. I'd be worried by that. I wonder whether they have sufficiently strong underwriting standards to deal with this high-risk environment. The major banks are sitting at 7.6%, which is significantly below the mutuals. And the regional banks are below the majors. And the foreign banks are the lowest of them all. So interestingly, the foreign banks are writing a lot of 80 to 90% loan-to-value ratios, but they're writing significantly lower numbers of the above 90% loan-to-value ratios. So my question to the management teams within the mutual sector is, are they fully across what's happening with regard to the higher loan-to-value ratio loans? It seems to me that intrinsically there are risks in the system. So I hope that's been useful, because I think we can summarize it as follows. We know that investment loans are a smaller proportion than they used to be. We know that interest-only loans are a smaller proportion than they used to. But we also am concerned by some of the higher loan-to-value ratios that we're seeing and the proportion of loans being written outside serviceability standards. So essentially my view is that there are still risks in the underwriting system even now, and this may present more risks downstream later. So I hope you found that useful. in terms of understanding some of the inner workings within the lending standards within the various institutions across Australia. It's worth saying, of course, that APRA does not report individual banks at all. They only report them in these relatively high-level buckets. So actually it's very hard to detect which banks within the portfolio are potentially lending more or less, or higher risk or lower risk. I'm afraid that's an unknown because there is no detail below this from APRA. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.